The truth about probability. 10 facts. Every trader can't afford to ignore. In trading, probability isn't just a buzzword. It's the backbone of every decision you make. Yet, many traders misunderstand or completely ignore how probability actually works. That results to emotional trading, inconsistent results, and blown accounts. If you're serious about becoming a consistently profitable trader, these 10 truths about probability are non-negotiable. Let's dive in. 1. Trading is a game of probabilities, not certainties. No setup, no matter how perfect, can guarantee a win. Every trade is a probability-based decision, not a promise. Yet, many traders operate from a mindset of expectation instead of possibility. They treat one trade as make or break, putting enormous pressure on a single outcome. The professional trader understands one trade doesn't matter. What matters is how you execute over 100 trades. That's when your edge plays out. Think in probabilities, not in outcomes. You can do everything right and still lose. That's the game. 2. Your edge is just a probability, not a fortune-telling tool. An edge is something that gives you a statistical advantage in the markets. It could be a chart pattern, a price action behavior, a volume signal, anything that wins more than it loses over time. But an edge isn't about predicting the future. It's about playing the same high-probability hand over and over. If your edge wins 60% of the time, you'll still lose 40 out of every 100 trades. The key is consistency in execution, not cherry-picking when to trust your edge. 3. Probability doesn't work in the short term. Many traders think that after a few losing trades, they're due for a win. But that is the gambler's fallacy. The idea that random outcomes should even out quickly. In reality, you can have 10 losing trades in a row and still have a profitable system. Probability plays out over large sample sizes. If your edge wins 60% of the time, that doesn't mean you'll win 6 out of every 10 trades. It means you'll win 60 out of every 100, but you might win 3 in one group of 10 and 9 in another. Short-term randomness is real. Respect it. 4. Losing streaks are normal and predictable. You can calculate the likelihood of drawdowns and losing streaks using basic math. For instance, if your win rate is 60%, you still have a statistical chance of encountering 5 or more losses in a row. Traders who don't understand this panic when they hit a losing streak, thinking something is wrong with their system. In truth, this is just statistical noise and the cost of doing business. The pros expect drawdowns. They plan for them with proper risk management. 5. A high win rate doesn't equal profitability. Let's say you win 90% of your trades, but every time you lose, you give back all your gains. Now compare that to someone who wins 40% of the time, but makes twice as much on wins than they lose on losses. Who's more profitable? Obviously, the second trader. A high win rate feels good, but it often comes with tight take profits and massive stop losses. The moment one big loss hits, it wipes out weeks of progress. Don't chase win rates. Chase favorable risk to reward. 6th, risk to reward ratios. Influence. Probability more than you think. If you target 1 to 3 risk to reward, you can be profitable even if you only win 30% of the time. But if you trade 1 to 1, you need to win more than 50% just to break even. The risk to reward ratio, R to R, sets the minimum win rate you need to be profitable. For example, 1 to 1 R to R requires a win rate above 50%. 1 to 2 R to R requires just 34%. 1 to 3 R to R requires only 25%. Once you understand this, you realize the math of trading is more powerful than feelings or forecasts. 7. Randomness makes short-term results unreliable. Flip a coin 5 times, and you might get heads all 5 times. That doesn't make the coin unfair. It's just randomness in a small sample. Likewise, 5 losing trades don't mean your strategy is broken, and 5 wins don't mean you're a genius. Most traders confuse skill with luck in the short term. Evaluate your trading system over at least 50 to 100 trades before making changes. Randomness is too noisy to judge anything shorter. 8. Emotions get stronger. When you ignore probability. When you forget that trading is a probability game, your emotions take over. You take losses personally. You fear missing out on the one big move. You hesitate because you're afraid of being wrong. All of these reactions come from attaching too much significance to one trade, but if you know it's just one of 100, you're more detached, disciplined, and objective. Probability thinking is the antidote to emotional trading. 9. Journaling helps you see the truth behind your edge. Most traders think their strategy is either working or not, based on a few wins or losses. But trading success is about data, not drama. Journaling your trades with metrics like win-loss outcome, risk to reward, achieved setup quality, and entry-exit notes gives you the full picture. Over time, you'll discover if you have a real statistical edge or just a bunch of random trades strung together. Probability lives in the data. Track it. 10. Even probabilities change with context. Market conditions shift, trending, ranging, volatile, or calm. Your setup that works well in a trending market might fail in a choppy one. That doesn't mean it's a bad strategy, just that probabilities are dynamic. Your system's win rate can fluctuate based on time of day, news events, or market structure. The best traders adapt. They understand probability isn't static. It's flexible, living, breathing, and their edge evolves with it. Adopt this mindset. Fall in love with uncertainty. Here's the hard truth. Trading is uncomfortable. You're never 100% sure. You'll always feel a little fear, doubt, and hesitation. Because you're dealing with uncertainty by design. But that's what makes the market profitable. If it were certain, the edge would disappear. Great traders don't avoid uncertainty. They embrace it. They trust the math, control what they can, risk, process, mindset, and surrender the rest to probability. In conclusion, build your edge on the rock of probability. Probability isn't something you use after you've placed a trade. It's the foundation of your entire trading philosophy. Here's a recap of what every trader must understand. Trades are probabilistic, not guaranteed. Your edge works over time, not every time. You must survive short-term randomness. Losing streaks are part of the game. High win rates can be deceptive. Risk to reward is your real edge. Randomness hides truth in the short term. Emotions fade when you think probabilistically. Journaling exposes your true edge. Probability changes with context. Stay adaptive. When you truly internalize these truths, trading becomes less about guessing and more about executing. You stop asking, "Will this trade win?" and start asking, "Did I follow my edge?" And that's the moment you go from gambling to trading like a professional.